Hello, everybody. Welcome to the 60th edition of Netra on the 5th of every month for the past 3 months. And over these past 60 months, the intent has been very simple: never predicting, never catering to any one section of the segment, just pure data driven insight on where we are without knowing where we are going. So, this edition is literally just that. It's about about India from a macro lens, about where we are in the cycle. So, to present, I will invite Sahil. Just before that, as a side note, I will request you all to post in your questions in the question answers tab on your screen. So we will take them collectively towards the end. Thank you. Sahil, over to you.
Thank you, Pragati, and welcome to all of you. So we'll be going through the 60th edition this time, and we'll be straight away jump into the report. And there is a lot to talk about. So we'll be discussing DSP Netra May edition. The first section is very focused towards systematic investment plan. And why did we think about talking about SIPs? Because there has been a lot of debate lately in the last 18 months to about 24 months or longer. SIP returns have been more or less flat. So a lot of investors have started questioning whether SIP is a great tool or not. And it's a valid question. And largely when things go wrong is when we start questioning. When they are going right, we usually enjoy the fruits of what has gone right. And when things go wrong, we start to question stuff. So we said that, can we come up with data? So during the last month, we came up with a detailed explanation on how SIP or dollar cost averaging has been a tool which has been around for almost 100 years. And we showed with data that a lot of market commentators and researchers have, with data, shown how SIP is a superior tool. Okay, so we'll talk about this section. Benjamin Graham, as you can see on your screen, has said that no one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging and nothing but SIP. So why Ben Graham and many other investing greats have spoken about methodical, regular SIP investing, while a lot of commentators recently have spoken negatively about it. So we look at data. So we've put out some data here, looked at a number of global markets. So if you look closely, what we have shown here is lump sum returns, lump sum real returns, which is adjusted for inflation, SIP returns over the last 30 years, and SIP real returns over the last 30 years. So two very important inputs, which some of you might have missed while reading it. All this data is based on price indices. It does not have dividend reinvestment because that data is not available. If you put that data in this engine, the returns overall will go up significantly for almost all countries because we have not built in dividends built back in, right? So if you put that data, both lump sum and real returns can improve. But in any case, if you look closely, SIP returns in almost all countries are superior or similar to lump sum returns. Wherever they are, close to 0%, you will see that lump sum returns are also negative, which means that the markets did not actually do well, right, in those countries. But if you look closely, SIP returns on a real basis, real returns means adjusted for inflation, has protected and grown the value of capital or value of investment over a long period of time. A lot of people might think that 1% real return is too small, but if you just do a mathematical exercise and if you look at what 1% achieves over a 30-year horizon, you will be surprised, right? You will be surprised to see that 30-year returns can be significantly high with just 1% real return, right? Second is that SIP is not a magic bullet. That's what we've written here. If you look at it's a method, right? If you look at the 5-year minimum returns or the drawdown, even in SIP, the drawdowns are almost 20%, which means that you start a SIP, at some point in time, your portfolio can show 15-20% drawdown also within a 5-year period. And this happens in all the market. It is very normal. So even if you're not looking at high SIP returns or you are looking at negative SIP returns over the last 2 to 3 years, it's a very normal phenomenon, right? And you can see with data that it has happened many times. There is nothing to be surprised about. Uh, Second thing is that if you look at how much has SIP generated over and above 8%, just a small benchmark that we took, in many countries, there are a lot of times when SIP returns have been meaningfully large, right? This gives you a lot of confidence. Now, the question is, why does it work, right? We'll speak about some other nuances as we go ahead, but two, three very important ideas about SIP. First is, what is an SIP? SIP is that if you start a monthly investment plan and you continue it for a very long time. What is very long time? Maybe at least 10 years or more, right? We've taken 30-year data. It can probably give you a very close to average kind of returns, right? And I will tell you what this average return is because a lot of people have no idea what average returns are. We'll talk about that in the next slide. Second is that the method of doing SIP is that once you start it, you should not stop it. The moment you stop it, it is not a SIP. It is some sort of a lump sum done or spread over a period of time, right? And therefore, the method is you start it and don't stop it. Why does it work? Because by doing SIP, you are doing two things. One, you are accepting that over a very long period of time, you will get average prices. Your purchase prices will get averaged out, right? Which means that if you have average prices over a period of time when the market rises over and above the average, you will make that return. Second, it is also an antidote to stupidity, which means let's say that we are not very smart as investors. Let's say we work in a technology sector or as professionals, as doctors or lawyers, and finance is not what we do, right? In that case, SIP helps you take away that requirement of having investment intellect, right? Because what you're doing is you are spreading out your investment, which takes out the timing factor completely, which means that valuations, which is, for example, today, will not matter if you continue it for more than a decade or so. The reason is that your investment will get spread out. So there are a few lessons from this slide. I put it here. First is SIP is hedge against our behavioral biases, which means that it is our own behavior that causes us to stop or start investment, redeem at the wrong time. A SIP helps us avoid all of it. Second is that it is an acceptance of long-term average outcomes. This is what I just spoke about. It works when we remove ourselves and let the structure do its job, which means that you start it and don't stop it. And there is enough historical and mathematical evidence. We've reproduced it many times over the last 2-3 years. The only problem is that when things are not so good, mathematics is insufficient to help our confidence, right? Our confidence shakes. No number or mathematics help us when you see negative on the screen. But if you are rational at that point in time, in that instance, you can continue to believe that mathematics holds over a period of time. Last is that it is a process and you should not interfere with it. Now, as I said that it can help you get very close to average returns. And we wrote this article to tell you why average returns are so difficult to get, right? So I will explain to you. There is a blog link at the bottom. We'll also share it in the comment section. And I urge all of you to read that blog. It will, structurally tell you three very, very important points on why average returns are so hard to get. Now let's assume that over the last 25 years, Nifty has delivered 12% average return. The average is slightly high, but let's stick to 12%. Now, when we start looking at the future, we sometimes need an anchor. We need to know what kind of returns are possible, right? So many a times we go back and stick to the historical number and we say that if it has delivered 12% in the last 25 years, maybe it will deliver 10 or 14 or maybe 12% in the next 25 years, right? So we use it as an anchor. Now I will tell you how hard it is to get 12%. Although a lot of market commentators continuously tell you that it is much easier to make 15% or 20% or higher returns by doing some activities. But let's look at mathematically what does this 12% is and what does it mean? First, that if you extrapolate 12% into the future, it is a mistake. So 12% average return belongs to people who invested 25 years ago or who continued their SIP 25 years ago. that return does not belong to people who start today because future is unknown. You can see that even the best performing markets in the world, like S&P 500, were flat for almost 15 to 17 years. Between 1998 to 2015 or 13, S&P 500 delivered no returns, right? Even Japanese Nikkei was flat for 30 years. In case of India, also Indian markets were flat between 1992 to 2002, right? Again, flat between 2008 to 2013, 14, right? So there are a lot of instances where you will find that um, the past is not replicated into the future, and therefore uh, trying to project history as a true reflection of the future, it may not be enough, right? So first is that it is also a disclaimer of the mutual fund industry, right? And it's the same thing that we don't know the future, right? And therefore just saying that 12% is the average, and you can put many anchors, right? For example, ROE plus reinvestment rate will get you close to 12% return. You can also say that nominal GDP growth rate also gets you close to 12% return. So there are a lot of anchors to think about, which gets you that number. But the point is that none of them are known that what will these numbers be in the future. Second is that we also make a mistake that the average return belongs to us. Okay, so here I will introduce a concept called the power law or the Pareto principle. What does it mean? So Pareto said that if there is 100 rupees of wealth or income, 80 rupees of that belongs to 20% of the people. So let's say if there are 100 people, 20 of them will make 80% of the income, or they will hold 80% of the wealth, which means that there is a lot of inequality, or it is loop sided. It is the same with everything else, right? Whether look at the quality of doctors or lawyers or fund managers, you will always find that a small cohort will earn more than everybody else. So let's take an example here. Let's say that in the last 25 years, if Nifty has delivered 12% CAGR, let's assume that the total wealth created is 100 rupees. Okay, so that 12% CAGR translates to 100 rupees of wealth. Now let's apply the Pareto principle. What does Pareto principle say? That if there are 100 investors, 20 out of those 100 made 80 out of the 100 rupees. So total wealth was 100 rupees. Some 20 people got 80 out of it, right? So very, very loop sided. Let's apply the Pareto principle once again. What does it say? If you take those 20 people who made 80 rupees, apply 80-20 rule once again, 4 people would have made 64 rupees. Which means that when you look at the 12% CAGR returns and do the same principle here, you will find that there are maybe 3 or 4 people who would have made 30+% CAGR. And almost all of the rest of the investors would have made less than FD returns, right? That is how the markets work, which means that the average return that you see over history is not the average experience of the whole crowd, right? Which means that a few very smart investors would have made a huge amount of CAGR. What is the conclusion from this? That even if you make average returns, you are probably better than 90% of the investors in the market, right? This is the hard truth. Very, very difficult to digest, but that is how the numbers work. Third concept is called ergodicity. It's a difficult word, but what does it mean? That an individual investor's journey is not the same as the market journey. Okay, how do I explain this? Let's say there is a competition where you would have seen this in a lot of world records like Guinness, etc. That people cross from one building to the other, right? Um, they rope walk, right? From one building rooftop to the other. And let's assume there are two type of groups. One, 50 people crossing from one building to the other, rope walking. And in the second, let's say there is only one individual. Let's say this is me, right? And I'm crossing 50 times. So here one person will cross one time each, and there are 50 people, so 50 total crossings. Here I'm going to cross 50 times, right? Now, what is the problem? If one person falls from this group of 50, the total loss is 2%. The game goes on, it does not stop. The group can still achieve the objective. This is the stock market, right? It continues, it produces average returns. Now, this is me. Let's assume that I could cross 50 times. I will also get the experience of these 50 people, right? But what if I fall in the first instance itself, right? Then the game stops, the game is over, and I make a complete loss, right? This is called the risk of ruin. How do we think about this in the real world? So think about an individual who started investing, let's say, just 2 months prior to COVID, right? Nobody knew COVID will occur. That person started investing, and during COVID, the portfolio fell 40-50%. And that person said that stock market is not the place to be. I'm going to exit. And that person exited the complete portfolio. Now think about that person sitting from that day to today. A lot of people will say Nifty has delivered average CAGR of 18% or 20%, but for that person, there is no average CAGR, there is no average return. And therefore, earning that average return is very, very difficult because of these three reasons. One, future is not the same as the past, it is much more volatile and fluctuating. Second, that the returns are not equal. Some people make a lot, other people make very, very less, which means that even some SEBI studies for FNO trading has put these numbers not as 80-10, 80-20, but 90-10, which means that it is even more loop-sided. So a lot of people that come on television and you see them talking about wealth creation, you can count them on fingers. That is the reason why, right? Maybe some of them are lucky, maybe some of them are skillful, but the point is that there are very few who make that 25 to 30% CAGR. And therefore, average returns are very, very superior than most of the people. And the third concept, as I told you, that we run a risk of ruin as individual investor. Therefore, averages can make us blind, right? You might feel that it's very easy to get them. It's not very easy to get them. Now, why does SIP is mentioned here? The SIP can help you get close to average. Why? Because over a long period of time, you are going to get those average outcomes just by being in the market, right? And therefore, this is the main reason why you should be thinking about SIP, not about 1 year, 2 year returns, not about whether it's a right instrument or a wrong instrument. The reason is that it is a mathematical method which can get you close to the average. And as I told you, according to me, 90% of the investors find it hard to get just average returns, right? And therefore, this method's become very, very powerful. And in this slide here, we show that the difference between investor return and market return is actually our own behavior, right? And it can get influenced for all of us. And let me tell you that even a fund manager is not immune to it, right? They also have behavioral biases which can reduce return. So therefore, SIP becomes a very, very powerful tool, and we should think about it from a very long-term perspective. Let's go to the second section, which is a short section on why do we still think and continue to think that large caps are a preferred bet over SMIDs. You would have seen small and mid caps have done exceedingly well from recent lows. They have done exceedingly well. But two very important consideration when you look at the Nifty index, which is largely the large cap dominated index, you will see that the long-term valuations have dipped below the current valuations have dipped below the long-term average, right? Which tells you that lot of large caps have come close to long-term average valuations. Some of you might argue that the long-term average itself has come up, which is true, which means that large caps are not cheap in the true essence. They are just at average, right? Uh, Second is that if you do a side-by-side comparison of small caps and mid cap, you will be able to see that small caps are at a much higher premium than large caps, small and mid cap. You can see that on a trailing price to book basis, small caps trade at 4 times versus a long-term average of 2.8 times and bottom cycle valuations of 1.8 times. Market cap to GDP for SMID is 37% versus long-term average of 22%, almost a 50% premium. Forward multiples are at 24 times versus long-term average of 18 times. Look at large caps. Their trailing price to book is lower than their long-term average. Market cap to GD is slightly higher, but still not comparable to the fraud that is there in mid and small cap. 1 year forward multiple is close to long-term average. If you look at where we bottomed, it was at long-term average. We showed you that also. Relative to emerging markets, we are still at a premium, but the premium is closer to long-term average. For small and mid cap, that number is very, very high, way too high than comfort, right? Similarly, if you compare it to bond yields or trailing returns, everywhere you will find that there is a lot more comfort in large cap versus SMID. Now, how to think about this? So, if you go back to 2024, we repeatedly said that SMIDs have valuation froth, and it will be very difficult to expect very high returns. And 2 year hence, you saw that even bond markets or short-term debt was able to beat small and mid caps. And the reason was that valuations were high. And we are at the same juncture right now where you will see on a relative basis, large caps are priced much better. In the short term, it will be very difficult to reconcile this in our minds that when small and mid caps are doing so well, why should we stick to large cap? But this is what the data tells you, that there is better margin of safety, better quality, and less valuation in large caps. And therefore, we still think that large caps are a better bet currently in India. The next section is on private consumption, and it is in the slow lane. There is a lot of commentary about why Indian consumption is so slow, and some commentators have also highlighted that it can become a big problem, and therefore Indian equity is not a great place to be. So we said that let's look at some data. This is India's private consumption, what is called private consumption or private final consumption expenditure. It's a part of the GDP data. You can see right now our 2020 average is 10.4% growth, and this is the slowest average since we have data, right? You can go back to FY 71 and do these averages. This is the slowest that we've ever been in data. And if you look closely, we've been slow since about FY 15, right? We haven't really recovered after that. Our numbers are below our long-term average numbers. Repeatedly, we had demonetization, IL&FS, COVID, etc. A lot of shocks to the economy, and that has dented our consumption cycle to a greater extent, right? Now, the point is this the point to write it off? I don't think so. The reason is that private consumption itself is a very, very cyclical phenomenon. You can see that we had slowdown phases earlier also, and then they recovered very, very fast, and you had many years of very strong growth, and it has repeated many a times in the past. So the point is that if you had a 10-year lean period in consumption, right? Then in the 11th year or in the 12th year is not the time to be negative about consumption, right? You might not feel positive about it. That is all right. You might wait for it to recover. That is also all right. But I don't think this is the time to write it off, right? So we'll look at what has slowed down consumption. So there are some concurrent indicators. For example, households are not building enough houses, one of a very strong outcome of poor growth and therefore poor incomes. Construction activity has weakened significantly over the last 1.5, 2 years. Um, Wage growth is very slow. You can see central government spending on wages is just 8% YOY, very close to the nominal GDP number. So real growth is very slow. BSC 500 wage bill growth has been very slow. Maybe it is bottoming, we don't know, but it is very slow. In fact, if you remember, those who have read Netra or heard us, 2 years ago when it was topping out, we came out with a detailed sector by sector analysis on telling you why this is a worrying sign, right? Today, we are exactly at the opposite end where we are sitting maybe close to the bottom. There is no way to know. But we are saying that there is a good chance that we see a recovery from here rather than seeing a uh, further deterioration. Maybe the recovery is shallow or steep. We have no clue, right? But there is a good chance that we are in the recovery phase. Labor intensive exports have been very, very weak. And what has happened over the last 3 years is that households have taken huge debt, personal loans, just to maintain their consumption pattern or what is called lifestyle inflation. So, what they have done is their incomes have not grown significantly. So, they have substituted that by taking loans. And therefore, consumption has not improved significantly. It has just maintained at a slow pace. So, these are the drags that are visible. Uh, what is holding up? Some premium consumption has bounced back, whether you look at non-oil imports or utility vehicle sales. Some there is some uptick in loan growth, which is outpacing deposit growth. Personal loans have stopped going down. RBI had taken a very strong stance in reducing unsecured credit. I think that has also now stopped. So this is something which is probably holding up the consumption cycle as of now, but it is not enough, right? We need to see more indicators come alive or improve for us to conclusively say that we have started to improve, right? Uh, the turn that we need is in credit, and we've seen some credit growth which is improving. Again, it's not enough. One important indicator could be that credit growth starts to flow from corporates, right? They start borrowing, which is not happening as of now, but there is some signs that credit growth has started to improve. Second is that banking sector NPA are at multi-year low, so banks have enough room to lend money. I will show in the next section also that corporates have also enough room to borrow, right? We'll show in the next cycle. What is missing is probably confidence, right? The confidence in the economy is missing. Sometimes there is no way to estimate when that confidence will recover, right? And this is something which is very important. And let me tell you by experience that no economist or statistician or market participant can tell you for sure that when the confidence will um, recover or come back in the economy. There is no way to judge it. What do we have? We know that most indicators that we watch are at cyclical lows. Some of them have started to recover. Uh, and therefore, there is no reason for us to say that consumption is probably going to weaken more. Maybe we can say that it may not improve a lot, uh, but if there is a way forward from here, it is probably continuation of the sluggish consumption that we've seen without further deterioration, or a steep improvement in the consumption cycle, right? Some of those indicators, very few of them, have started to appear in numbers, which I showed you. For example, bottoming out of wage bill growth, credit growth coming back, ability of households and corporates to borrow. And because of this, Gulf War, there is some small mini stimuluses which are getting built into the system. Right now, they don't look like stimuluses, right? They don't look like stimuli, but over a period of time when crisis ends, some of them will become more apparent, right? And therefore, we think that this is the time to probably take a neutral to positive stance on India's consumption rather than thinking about it in negative terms, right? We thought about it in more pessimistic terms 2 years ago, if you remember, but I think that time has ended, right? The next is the corporate India cycle, and it also needs a big consumption revival, right? And we'll see why and how is that important, right? So first is that in this cycle, ROEs have remained below the previous cyclical high. So return on equity in the 2002 to 7 cycle went to 22%. In fact, it went to as high as 25% in a few quarters. On an average, it was here. This is exponential, right? And in this cycle, it peaked out 500 to 600 basis points below the previous cycle, right? Which means that the quality of earnings did not improve as much as it did in 2003 to 7 cycle. What was the reason? In the 2002 to 7 cycle, we had a three engine cycle. Margins were expanding. That means profitability was exploding. Asset turn was very high. Top line growth was very, very high. And corporates took a lot of debt. So when you take debt, your ROC goes up significantly, ROEs shoot up, right? Because you're taking debt and returns to equity shareholder even goes even higher. So the market begins to reward such companies who are able to take debt. For example, if your ROEs are, let's assume 15% or 13%, and your cost of capital is 7-8%, and you grow your top line significantly by in a cycle where margin are expanding, that's a recipe for a massive upgrade, right? And that is what happened in the 2002 to 7 cycle. In this cycle, there was a significant margin improvement, right? So this is the net profit margin. Profit margins improved from very bad levels of 5-6% to 9%. In the previous cycle, they went as high as 10%, right? So we were slightly muted than the last cycle, but there was a big margin improvement in India, largely based on efficiency, cost cutting, reduction in raw material margins, right? But the top line did not grow as much as the profits grew. So, for example, for corporate India, top line growth has been maybe 10% CAGR, while profit growth or PAT growth has been more than 18% CAGR. So which tells you that profitability for corporate India did not come from strong tailwinds in the business mix, right? It largely came from efficiency gains. Margins improved, raw material costs went down, companies became more lean, they paid down their debt, debt servicing became very, very low, right? All of them helped them to become better from a balance sheet perspective. Now, why did this happen? So, if you look at one missing driver in this cycle has been asset turns, which means that whatever assets companies hold, they have not been able to utilize them. It is called sweating of assets. So, if you have a factory, how much do you run that factory to produce same amount of goods and services? Goods is will define what is your asset turn, how much your asset is being utilized, right? So, what we have seen is that the revenue growth was much lower in this cycle versus the last cycle, which means that asset turns were lower, and which is a the signal came from that top line growth was not as much as strong as it should be. Second is why it did not happen. Probably that corporate India did not see a strong consumption cycle, right? In 2002 to 7 cycle, India's capex was rising at a faster pace than consumption, right? So you may argue that even in that cycle, asset turns would have been lower, but that was not the case because the private final consumption itself was growing at 14-15% CAGR in nominal terms, which was very explosive. In this cycle, it has been below 10% growth rate, right? So a lack of consumption, lack of demand visibility has probably not prodded the corporate India enough to increase its asset turnover, right? So even when they were paring down their debt, they were not putting in more capacity. They were improving their balance sheets completely. The top line growth did not rise as much, and probably it has got a lot to do with overall, you know, compression in growth, compression in demand, right? Which is what the last section was all about. Now, second, another lever was that because probably it is our conjecture may or may not be true, because the corporate India did not see such a strong demand cycle, and it is all interlinked, right? If companies don't spend enough, um, growth will also suffer, right? The government of India can only do so much, right? So corporate India chose to delever, reduce its debt, reduce its dependence on debt, and therefore improved its balance sheet quality materially, right? And so you can see that total asset to total equity, that number, if you look at the equity multiplier, has also fallen, right? Which means that very less new investment was made by corporate India, and most of the internal accruals were utilized to improve the balance sheet size. So balance sheet quality. So now where we are right now, median debt to asset is at one of the lowest levels we've seen in a very, very long time. I think maybe 20, 30 years. So corporate India is balance sheet is ready. It can bear almost any crisis right now. Most corporates do not have debt. Many corporates who were burnt in the last cycle because of taking a lot of debt, specifically those which are driven by corporate houses or business families, they have not taken debt in this cycle, and that has improved the balance sheet quality significantly. Which means that corporate India balance sheet is very, very ready for the next wave of growth. Now, whether they will borrow money or not, we have no clue, right? Whether they will take on more debt to create investments, we don't know. We don't have the data or foresight to tell you. All we are saying that balance sheets are ready. What can prod them, what can prod businesses to take on more debt is actually better demand. So if you see more demand visibility, second, capacity utilization levels hit very high numbers. They go above 80%, 85%. Corporates will be very, very happy to put in more capex, right? Unfortunately, over the last 2, 3 years, even after the COVID recovery, capacity utilization levels never went up to those levels, right? And therefore, there was no need for doing enough capex. So today we have these conditions where consumption is probably, according to us, closer to trough. Now, whether it improves or not, we have no idea. But there are good conditions available. Second, balance sheets of corporate India is very strong. They can afford to take on debt if they see improvement in consumption, right? Now, if you understand it properly, the lever starts at the consumption recovery, and then of course everything can feed back into it. What will cause that lever to move? It's very hard to say. You can make some conjecture that maybe government of India will spend a lot and kickstart the cycle. Second could be that the interest rates are slashed so much or bond yields fall so much that it makes a lot of sense to kickstart the cycle. So any of that can happen. We have no clue what will be the starter, but it's very clear that the fundamentals are more aligned today than they were earlier. But if you go back and think about valuations, the valuation comfort still rests with places where uh, valuations for companies are low, asset qualities are very high, which is largely in the large cap bucket as we speak today. The last slide, where we will end this and we go to question and answer, is about linear extrapolation, which ties up very clearly to what we've read here. If you do linear extrapolation, even a lizard can become a dinosaur if it continues to grow, but that is not true. Everything has an upper limit or a natural cycle. And in finance, almost everything is cyclical in nature. So whether it is flows of investors, you can talk about FI flows, FDI flows, profit margins, valuations, or you can talk about private consumption. Many of these things, when they are at the trough or at an extremity, we will come and talk about it. Unfortunately, when they are bad, like SIP returns, a lot of people extrapolate those bad or good things on both sides. Our job is to highlight that we are at an extremity. We don't know whether that extremity will continue or not. There is no way to know it. But we can make sure that we do not participate in an irrational extremity and we take a step back. So, with this, I will stop here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.